Hey everyone, welcome back to the Mia's Finance Life, coming to you live from the heart of 2025, where the economic landscape is as unpredictable as ever, and every day feels like a roller coaster ride for your wallet. Today, I'm going to break down 10 everyday pitfalls that could actually make you poorer, and I'm not talking about abstract theories or far off doom and gloom. I'm talking real stuff based on current events, hard data, and stories you might even recognize from your own daily grind. Stick with me till the end because I'm also going to show you practical ways to avoid these traps and even some alternatives that might just help you keep your hard-earned cash safe. Now, I know a lot of you are out there feeling the pinch from rising prices on everything from groceries to gas. And while some of us are riding high on investments and other high-earning ventures, for the everyday American, things can get pretty tight if you're not careful. According to a recent survey by Northwestern Mutual, about 2/3 of US adults are saying inflation is their top financial concern. And let me tell you, that's no joke when you're trying to budget your monthly expenses. Let's dive right into the first major pitfall: escalating living costs, which cover everything from housing and healthcare to energy and transportation. Now, we all know that rent and mortgage payments are eating up a bigger slice of our paycheck than ever before. In 2025, many reports indicate that rent inflation is still stubbornly high. Cleveland Fed research even predicts that rent inflation may not drop below pre-2020 averages until mid-2026. That means if you're paying a premium in a hotspot city, your monthly outlay is only going to keep climbing unless you find some creative workaround. For instance, a buddy of mine in Chicago shared that his rent shot up by nearly 10% in just the past year, which forced him to cut back on dining out and even his gym membership. The key takeaway here, it might be time to explore alternative living arrangements, like co-living spaces or even relocating to an emerging suburb where housing costs haven't skyrocketed yet. And remember, if you're thinking about buying a home, doing thorough research on local market trends is crucial, because overpaying for property in a cooling market can lock you into high monthly payments without a corresponding increase in property value. Data from the Federal Reserve and recent housing market analysis show that many middle-income households are feeling squeezed by these relentless price hikes. Moving on to our second point, the mounting burden of personal debt and the pitfalls of relying too much on credit. You've probably seen the headlines credit card balances are on the rise, and for many, it's becoming a trap that's hard to escape. With wages growing only modestly, the temptation to finance lifestyle upgrades or even everyday purchases with credit is high. For example, consider the story of a family in Ohio that I read about recently. Despite earning a decent income, they ended up accumulating over $20,000 in credit card debt because unexpected medical bills and car repairs forced them to rely on credit. And it's not just about credit cards, auto loans, student loans, and even the increasing popularity of buy now, pay later services are contributing to a scenario where the average American is more leveraged than ever before. The data from TransUnion and Equifax reveal that delinquency rates have crept up slightly compared to pre-pandemic levels, which is a warning sign that even if you're managing fine now, one major financial hiccup could send you spiraling. So what's the antidote? It's all about developing a rock-solid budget that prioritizes building an emergency fund. Experts suggest setting aside at least 3 to 6 months of living expenses so that when those unexpected costs hit, you're not forced to resort to high-interest debt. If you need to restructure your debt, consider talking to a financial advisor about consolidation options or negotiating lower interest rates with your creditors. Our third point is the danger of inadequate retirement planning. Many Americans still hope that Social Security will be enough to get them through their golden years. But the harsh reality is that with rising healthcare costs and an increasing number of retirees, relying solely on Social Security is a risky bet. A recent Fidelity study highlighted that about 60% of pre-retirees worry that their savings won't be enough, especially with projected healthcare expenses averaging around $165,000 during retirement. Let's take the example of Mike, a 55-year-old teacher from Texas, who always assumed that by working for another decade and relying on his pension and Social Security, he'd be set. Unfortunately, due to a combination of market volatility and the rising cost of living, Mike found himself scrambling to catch up on his retirement savings. This is a classic case of lifestyle inflation combined with insufficient planning. So, what can you do to avoid ending up in Mike's shoes? Start by automating your savings and maxing out contributions to tax-advantaged retirement accounts like 401k or IRAs. Even if it's just a small percentage of your income, consistency is key. And if you're already in debt, it might be wise to consult with a financial planner to create a realistic roadmap that balances debt repayment with long-term savings goals. Now, let's turn our attention to the fourth trap: inadequate insurance coverage. Now, I know insurance might not be the most glamorous topic, but trust me, skimping on coverage is like leaving your front door wide open and hoping nothing bad happens. Whether it's your health, your car, or your home, not having the right insurance can lead to financial ruin in an instant. For instance, consider a friend of mine who thought he could save a few bucks by choosing a policy with a high deductible for his car insurance. When a fender bender occurred, he ended up having to pay out of pocket hundreds of dollars that he hadn't planned for. Data from various sources, including research from Investopedia and recent articles on platforms like iTalkBB, show that even a small gap in coverage can lead to significant out-of-pocket expenses, pushing you further into debt. So my advice is simple: evaluate your risks carefully and choose insurance plans that might cost a little more each month, but save you from catastrophic losses later. Look into bundling policies for discounts, and always read the fine print to ensure you're not left vulnerable when life throws you a curveball. Moving on to pitfall number 5, the perils of high-fee investment products. Many of us have been seduced by flashy mutual funds or actively managed portfolios that promise sky-high returns. But what they often don't tell you is that those fees, they add up over time, eating away at your hard-earned gains. Think about it, even a 1% annual fee might not sound like much, but over decades that can translate into thousands of dollars in lost returns. I recently read a detailed piece on Investopedia that emphasized how switching to low-cost index funds and ETFs can save you a significant amount in fees. For example, one investor I know was paying over 1.5% in fees on an actively managed fund, only to see his returns lag far behind what he would have earned with a 0.2% fee index fund. The takeaway here is that you need to scrutinize what you're paying for, do your research, ask questions, and don't be afraid to move your money to a lower cost option if it means keeping more of your gains in your pocket. Now let's talk about pitfall number 6, poor tax planning. Taxes can be a silent wealth killer if you're not careful. Too many Americans leave money on the table by not taking full advantage of tax-advantaged accounts like 401k, IRAs, HSAs, or even the newer Roth options available these days. According to a recent study by Fidelity Investments, nearly 2/3 of Americans are either unaware of or underutilizing these accounts. It's crucial to plan ahead, not just for retirement, but for your overall tax strategy. For example, if you're in a higher tax bracket now, but expect to be in a lower bracket in retirement, a traditional 401k might make sense. But if you're younger and expect your income to rise, a Roth IRA might be more beneficial. Also, keep an eye on changes in tax laws and potential legislative shifts under the new administration. Those can impact deductions, credits, and even the way investment income is taxed. Working with a knowledgeable tax advisor might cost a bit upfront, but it can save you thousands down the line by ensuring you're not overpaying. Pitfall number 7 is a close cousin to poor tax planning: short-termism and the failure to focus on long-term planning. In today's fast-paced market, it's easy to get caught up in the excitement of short-term gains, day trading, speculative investments, or even impulsive big-ticket purchases that seem like a good idea at the moment. But here's the thing: chasing quick wins can lead to burnout and, more importantly, missed opportunities for long-term growth. Take the case of Susan, a small business owner who spent her savings on a series of speculative investments, hoping to double her money in a few months. When the market took a downturn, she found herself with significantly reduced savings and no safety net. Instead, the smart move is to create a balanced financial plan. That includes both long-term investments and short-term liquidity. Automate your contributions to retirement accounts, diversify your portfolio, and set aside a portion of your income in a high-yield savings account or even treasury securities. Building habits that prioritize long-term stability over short-term excitement is essential if you want to weather economic storms. Now, let's address pitfall number 8, mismanaging risk and liquidity. A lot of us think we're doing fine until an emergency comes knocking. Whether it's an unexpected job loss, a major health issue, or a sudden repair bill for your car or home, having liquid funds available is non-negotiable. Yet many people have their money tied up in investments that aren't easily accessible without penalties. Moreover, if you're overexposed to high-risk assets without a proper understanding of your risk tolerance, a market downturn can hit you harder than you'd expect. For instance, some investors have seen their portfolios shrink dramatically during volatile periods because they didn't maintain an appropriate balance between growth-oriented and safe liquid assets. The key here is to always have an emergency fund, ideally 3 to 6 months worth of living expenses, in an easily accessible account. And if you're investing, make sure you have a clear understanding of your risk tolerance and that your portfolio is diversified enough to handle market swings without forcing you to sell at a loss. It's all about finding that sweet spot where you're growing your wealth without jeopardizing your financial security. Next up is pitfall number 9. Ignoring macroeconomic signals and failing to adjust your strategy in response to policy changes. In today's economic environment, things like tariffs, trade wars, changes in immigration policy, and even shifts in government spending can have a direct impact on your personal finances. For example, with President Trump's tariff policies still a hot topic, studies have shown that these tariffs can directly impact the cost of everyday goods. Some estimates suggest that they could cost the average American household around $1,200 a year in reduced purchasing power. If you're not paying attention to these broader economic trends, you might find that your investments or savings aren't aligned with the realities of the market. Stay informed by regularly checking reliable financial news sources and understanding how proposed policies might affect different sectors. For instance, if tariffs are expected to push up prices on imported goods, you might want to adjust your budget or even your investment strategy to account for higher costs. It might also be a good time to explore domestic alternatives where possible. Being proactive and flexible in your financial planning can help you avoid unpleasant surprises down the road. Finally, pitfall number 10, the failure to diversify and manage liquidity properly. This is the old, don't put all your eggs in one basket advice, but it's more relevant today than ever, with the economy experiencing uncertainty from multiple fronts, be it inflation, shifting consumer spending, or unpredictable government policies. Relying too heavily on one type of investment or income stream can be disastrous. For example, some individuals still have nearly all their investments in a single asset class, like stocks or real estate, and when that sector takes a hit, they have no backup plan. Diversification across different asset classes, like stocks, bonds, real estate, commodities, and even alternative investments, can help mitigate risk and ensure that a downturn in one area won't completely wipe out your portfolio. Additionally, make sure that your investment strategy considers liquidity needs. It's not enough to have a diversified portfolio if a significant portion of it is locked away in assets that can't be easily converted to cash when an emergency arises. Monitoring the liquidity of your investments, such as keeping an eye on lockup periods or early withdrawal penalties, is critical for maintaining flexibility and avoiding forced selling during market downturns. All of these pitfalls are interconnected. For example, inadequate insurance coverage might force you to dip into your emergency fund, which in turn could lead you to sell off your long-term investments at a loss. Or, high fees on your investment products can reduce the overall growth of your portfolio, making it harder to reach your long-term financial goals. And poor tax planning can exacerbate these issues further, leaving you with less capital to reinvest or cover unexpected expenses. So, how can we protect ourselves? I've summarized 7 key points and compiled them into a table at the end of the video for your reference. Today, we mainly discussed 10 potential traps that could make us poorer from a financial perspective. In the next video, we'll talk about which unnecessary expenses we can cut to significantly ease our financial burden, as well as the top 10 opportunities that are most likely to make money right now. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights. Share your thoughts and experiences in the comments below. See you in the next video!